Welcome to yet another episode of The Big Picture. Today we talk about a few of the issues that we find in the US credit markets and what it means for investing. Over the last few weeks, we have seen multiple reports emerging from the US where we have seen stress again in the regional banks, something very similar to what happened with the Silicon Valley Bank in early 2023. We are seeing that some of the banks are under stress. And we also see a couple of delinquencies, couple of very notable defaults. First one being a company by name First Brands, and second one by a company by name Tricolor. Now, JP Morgan's CEO Jamie Dimon made a comment that when this kind of things happen, they don't happen in isolation. When there is a cockroach, he specifically mentioned that when there is a cockroach, you are likely to find more, and one needs to be very careful. And last week, Howard Marks wrote a memo titled "Cockroaches in Coal Mine," which essentially he rebuffed that idea in the sense, defaults are par for course in high yield high yield bond markets, and he said that it's something that investors should not be unduly worried about. But looking back, so what really happened in this? And we also read notes. We also read that US Fed intervened in the money markets over the last few weeks. So there is some stress. Definitely, there is no smoke without a fire. So is that a fire? Is that something that we should be worried of? It's something we'll talk about. So while since 2007, banks and investment banks have been significantly controlled in the sense that regulations have tightened to that extent that they cannot invest in private credit. A new category of funds, new category of investments called private credits or performing credit emerged since 2011, and it has grown significantly in size in the last 14 years. Now, whenever something grows in size at a rate higher than the general growth rate that we see all around, it is a sign for worry. And this is how most crises have happened. A new sector emerges and there is investment into the sector, or rather that particular sector grows, and at some level quality is compromised, and that leads to issues down the road. Now, is it something happening in private credit? Is the question for us to ponder about. As on the other side, what we also see is significant amount of capex being committed by companies which are into artificial intelligence. The AI stack that is being built globally by various very large tech players, the capex these are all astronomical sums being committed into this capex. Now, at some level, we think this is not completely capex, because traditionally capital expenditure is something which we know as an investment in a long duration asset, in a long dated asset, in more like a fixed asset which has a significant life. But when it comes to AI, there is a significant portion of this capex that goes into buying those chips which will power the AI data centers. Power as in run those processes. And these chips are specialized chips, and what we understand is these chips may not have a significant life as it's being portrayed. So what it means is a portion of the capex is actually going to be repeating year after year after year, or every 2 years. So let us for a moment assume that 30%, again, is just a number that I'm quoting, have no real reason to believe this could be the right number. Let's say 30% of your capex is into buying chips. You're going to be spending 30% every year or every second year in replacing these chips. Now, what you are going to be committing is 100 upfront and 30 every second or the third year. Now, in which case your returns or your total asset turnover ratio or your sales that these assets have to generate has to significantly be higher, and it has to keep growing at that rate to ensure that these projects make a certain IRR. Now, what really happens in a cycle is every cycle is born out of optimism and ends when that optimism is broken. Now, what is happening with AI cycle is there is all around optimism that AI can solve many of our problems. in terms of in particularly in services and automating manufacturing and things like that. And while that promise might hold true, the price consumers are willing to pay for that, we do not know at the moment, which means there is a significant risk of a top line or a sales or a revenue surprise. We may not have the revenues to meet this kind of IRRs. Again, we read a lot of reports about this as well. Now, what it means, another thing that is happening with AI capex is it is also being debt funded. Think of an asset you are creating, and every second year or third year, you need to add 30% more or to replace those chips and replace those equipments. It is going to continuously consume capital. The capital intensity of AI is something very significant. And this capital intensity, at some level, this capital is also getting funded by debt. So you have a double whammy where you have you are taking certain levels of debt, and two, some portion of these assets needs to be replaced. Some portion of your capex is continuous, is second year or every second year. So you have a situation where suddenly you realize AI is not remunerative. So this is something one needs to think about when looking at AI companies or companies that are benefiting from AI, companies as in the deep tech companies, the semiconductor companies or whatever. And along the line, around that, as investments happen, and as in case that you don't see the kind of revenue, you will also start optimizing in the sense you will find newer AI models which are far more efficient. So suddenly you realize this entire investment in AI infrastructure is, you ended up over investing. So to us, when we look at this, that is the risk that we look at. The risk is not what you see, risk is what you do not see. For us, when we look at what is happening around us, the biggest risk that we see in credit markets is the exposure that credit investors may have to this AI capex. It may not be today, but it is definitely there down the line. So if you are an investor in AI or AI theme, you made your money. We have been saying it, repeating the nth time. It's probably time to look at bets outside of AI globally. Thank you. We'll meet you with yet another episode of Big Picture soon.
Investment in securities market is subject to market risks. Read all the related documents carefully before investing.